We have a quick question here from Wayne, who says that today's session started off with a very strong risk-off tone in the market, but at the European session open, at the cash open, bond futures started to slip down lower. And Wayne just wants a little bit more clarity on exactly what that, why that was. So thanks for the question, Wayne. I think it's a great one because it allows us to talk a little bit more about the type of reaction that volatility can create in the market. And for those of you that don't know, the reason why Wayne is referring to bonds here from a risk-off point of view, or a risk-on point of view for that matter, is we would expect bonds to react in a specific way if we have a strong risk-on and a risk-off tone. And we would also expect other asset classes like equities and commodities and FX to also react in a specific way. Now, in today's session, which is 30 October 2020, we started out with a strong risk-off tone during the Asia-Pac session. But from after the European cash open, we did see a little bit of a mild downside coming into bonds, and possibly pointing to a change in the risk tone. So when this happens, the first thing to do is to try and look for possible reasons why that might be the case. Now, if you see that nothing has hit the wire, so if we go to the terminal at that time, if we see that nothing had really hit the wires that explains that type of move, then we can look for other movements across asset classes to see if there's similar reactions. So if we take a look, for example, in something like equities, we can see that at that same time, we also had a similar run higher at the same time in equity markets as well. Now, was there any fundamental news flow to cause that move at that time? Nothing really from what I can see here from the overall news flow. So if there's nothing from a news flow point of view that explains it, then we have seen similar moves across other asset classes like we did, then it might be pointing to a possible correction in that overall risk tone. So let me just quickly get that squawk down. Sorry, guys. So it might point to a possible correction in that overall risk tone. Now, of course, if it's not news related, it can happen for a couple of different reasons. It might be down to just normal ebb and flow of the market. So after a big move like we had last night and early morning, it might just be a little bit of a correction and a pullback in the market. Other times like now, it might also be down to month inflows because it is the last trading day of October. Sometimes it might be down to de-risking and profit taking because it's also the last day of the week. So might be some long bond positions being closed out for whatever reason going into the weekend. But in a session like today, and more specifically in a week like this, I think it's down to just volatility. So remember that during weeks like these, where we're expecting the US election coming up next week, and this is going to be a massive one, lots of expectations, we normally have that thinner liquidity and lower volume environment where market participants stay on the sidelines. And we can either expect very muted and lackluster moves as a result of that, or we can expect very large exacerbated moves as a result of that. And the important thing about that volatility that creates is that volatility can work both ways, which means with the same speed and pace that we saw downside moves this week in things like equities, volatility can cause the market to have a similar reaction in the other or opposite direction as well. Whether it's due to any of the reasons we mentioned, it's hard to say. But one of the reasons why we chose to or normally choose to stay clear and remain patient when trading these types of conditions are due to that two-way result that we can have in terms of volatility. Now, markets might be risk off 1 second in these environments and risk on the next without any real change in that overall cautious market sentiment. And it's these environments that can really chew into your profits because there is really no clear direction or sometimes reason as to why these markets are moving. Now, of course, whenever we see these types of environments in terms of volume and liquidity and that heightened volatility, there is arguably a higher probability for risk-off flows to remain compared to risk-on flows. But again, due to this type of uncertain environment, it's not really funny to see outsized moves in the opposite direction without any real obvious cause in the market. Now, it's always important to keep common correlations in mind as well, like we went back to equities to see whether it was a similar flow in terms of risk flows, but at other times it might also be something completely unrelated causing these moves. And for example, in our first video for today, we highlighted that the US 5-year forward inflation expectations saw some upside yesterday. Now, rising inflation expectations is usually a negative for fixed income securities like bonds, which can explain some of the upside. But as usual, in the markets, it might be a whole range of factors compared to just this one thing causing that downside in bonds. And with market conditions like this, it can be quite tricky to pinpoint, the exact cause, because always keep in mind that correlation does not necessarily always mean causation, which is a very important point to always keep in mind. So I hope that helps with the question, Wayne, and any others, please don't hesitate to let us know.